everyone, welcome to the third in this series of charity webinars, today looking at the topic of financial resilience post-crisis. These webinars are hosted by me, Rustomji of Browne Jacobson, James Saunders of Moore Kingston Smith, and Reid of Quilter Cheviot, together with a different guest panellist for each webinar. Today, we are joined by Rebecca Porta, Chief Executive of Bowel and Cancer Research and Bowel Disease Research Foundation. Financial resilience is an important area for charities at all times, but never more so than now, following a recent survey by the Institute of Fundraising, NCVO, and Charity Finance Group, which found that the sector expects income to fall by 24% for the year, which equates to a £12.4 billion shortfall. So James, if I could start with you, what have been the key statutory or regulatory advice, instructions or changes during the crisis?
Yes, hi Catherine. The main guidance for most organisations has been the material published by the Financial Reporting Council. That's the body that sets the UK's corporate governance and stewardship codes and also regulates auditors and accountants. And this advice has covered a practical guidance such as how to conduct AGMs without big groups getting together. It's included regulatory changes such as the formal extension to filing deadlines at Companies House, 3 months longer now. And it's included more advisory guidance on areas around corporate governance and financial reporting. And this has been for both companies and for auditors. And then for charities specifically, both the Charity Commission and the SORP making body, that's the SORP is the Statement of Recommended Practice, the main accounting guidance for charities. Both the Charity Commission and the SORP making body have published guidance for charities covering financial matters. The Charity Commission guidance includes material on particular charity-focused matters such as using unrestricted and restricted reserves, fundraising appeals, considerations of whether helping with a COVID-19 response is part of your charitable objectives and so on. And then the SORP making body issued guidance specifically on financial statements. And this looked at the potential impact of the control measures to contain COVID-19 on financial reporting by charities. The guidance considers the implications of the COVID-19 pandemic for the trustees' annual report, for going concern, for charity operations and for charities' governance, and for the value of charities' assets and liabilities, given the high levels of social disruption, the potentially reduced capacity of charities to staff their operations, and the wider economic impact of lockdown. And importantly, however, the guidance does say that the advice doesn't amend the SORP, and it's advisory in nature, which reflects, I think, the difficulty that any type of instructions will have in this type of scenario. It's really only able to take a broad brush approach to the situation, and it's ultimately going to be down to the individual entity to flesh out the details.
Thank you. I think that's really useful to have that focus on the Financial Reporting Council and the guidance that they're putting out, which obviously sounds very helpful to those that are struggling with these areas. And so what should trustees, management and finance teams be looking at in terms of financial resilience?
From a financial resilience standpoint, the key areas really for those in charge of any organisation, going concern, and the requirements and expectations around assessing going concern haven't changed. The circumstances, of course, have, and it's the assessment of the impact of those circumstances, the financial threat of the current and the future financial environment that needs to be considered. When all's said and done, the FRC has stated that the accounting and auditing standards haven't changed in the crisis. Indeed, the opposite is true in many ways. For consistency and comparability, regulations needs to stay the same, but directors and trustees still need to assess going concern in light of COVID-19. And of course, importantly, this assessment needs to cover at least 12 months into the future at any one time, particularly when signing accounts. So the FRC has also clarified that boards aren't expected to predict the extent and the duration of the COVID-19 pandemic, nor its consequences for the global economy. It is, however, reasonable to expect companies and entities to be able to articulate their expectations of the possible impacts on their specific business in different scenarios. And this is probably where another aspect of the going concern assessment needs to be highlighted. When looking forwards, trustees and management need to be considering what's termed significant judgments and estimation uncertainty, both very relevant in these cases. It's clearly very difficult to forecast income or indeed activity in general in the midterm now, especially for charities who have very many different income streams and income sources and a variety of activities as well. So there's a huge amount of uncertainty in this next 12-month period. What's the economy going to do? Changes to working patterns and locations, there's significant shifts in property requirements and tech needs, strategic and governance changes. But the uncertainty in this upcoming period, which is going to be difficult to budget for, is still going to have to be monitored and reported and explained. And in the same vein, when it comes to the auditing of financial statements, auditors are still going to be expected to challenge management appropriately in their judgments and to ensure that they have sufficient appropriate evidence to support the judgments made. And again, that challenge per se is not new, and it is not a change, but it is going to be affected and impacted by the financial environment in which we currently find ourselves. It's going to ask questions about the reliability of future income and the extent of future commitments in the full knowledge that both will be under pressure in the near future.
Thank you. And what are the main dangers during the crisis and then also coming out of the crisis?
Well, I've talked quite a lot there about the requirements, statutory, formal, informal, and to an extent from a financial standpoint, the period to date has been a challenge, but it hasn't necessarily been a real threat. The real threat is the upcoming period, which is all about uncertainty. The recent report from Pro Bono Economics forecast a £10 billion funding gap in the second half of 2020 for the charity sector. And I think this highlights the paradox, really, in a way that charities will find their services more in demand, but their income dropping. A rise in demand of services valued at £3 billion and a drop in income of £7 billion gets to that £10 billion gap. So it's difficult for most trustees to really be budgeting positively and confidently right now without a major element of hope in there, really. Hope that there will be some of the lucky few to get a piece of the government funding pie, which we already know is too small, or hope that some new income stream will prove successful, either fundraising or service provision. Hope in a V-shaped recovery, which creates wealth and generates positive national economic results and encourages private philanthropy, while also reducing the burden of increased demand for services. And combine all that with the possible need to modernise or change in some way to cope with the changing expectations of your beneficiaries, your workforce, and your other stakeholders. And you've got a huge number of moving parts that are going into your future financial assessments. And in terms of some other sort of specific areas, there'll be concerns around any external requirements you will have to meet, complying with bank covenants or other loan covenants if they're already in place, given hits to annual results and reserves. For charities with trading subsidiaries, being able to make gift aid payments legally is proving a challenge as reserves are hit. And in terms of assets and liabilities, hits to investment values and property values, and increases to things like costs and levels of pension scheme liabilities. And then in terms of just the simple wider economic effects on partners in a network or service providers who may also be struggling financially. So, yeah, I mean, lots to worry about there.
Thank you, James. So Will, if I could come to you next. So in your role as Head of Charities at Quilter Cheviot, obviously you're acting for a number of charity clients. And how do you think attitudes will change regarding reserves and how they are held, whether in cash or invested?
Well, I think it's always actually comes back to the nub of, if you like, sort of reserves full stop. And that sort of first, actually most important question is, what is the purpose of those reserves and why have you got them? I think you quite often see charities struggling when it comes to the report and accounts, going, how are we going to position our reserves in these accounts? How do we think we should start to try and pigeonhole these so that potential donors aren't going to start questioning why we've got so much money if we're in that fortunate position? But I think actually the conversation is before that. Why do you have them? They're clearly dependent on their particular need and the time frame of requirement. Depends really where they should be invested. So, if you're fortunate enough that you've got the reserves, for in terms of day-to-day running costs, and you're saying this is our kind of 6 months really rainy day, we need to be able to get this regardless of what's going on. Clearly, investment like that should be held as cash. Now, we all know sadly you're going to get no return from holding that in the bank at the moment, but on the flip side, the risks you're taking by exposing it to market risk in any form, all investments carry risk, and probably particularly now so with the sort of movement you've seen in gilt yields. Arguably, fixed interest is carrying as many risks, with different risks as just going and buying a sort of straightforward equity investment. So I think, as I said, the first part is why are you holding those? The Charity Commission clearly is keen to focus on why, if you're in a fortunate position to have significant reserves, why are you holding such significant reserves? Why aren't you using them to further your sort of charitable objects? But I think it's also remember that reserves really also are giving, if you like, comfort to sort of three other groups and three stakeholders. Firstly, it's the people you've actually got working for you in the charity. If I work here and we hit hard times, am I going to suddenly find I have no job tomorrow because we've run out of money? I'd say that's fairly important to give confidence there. Two is your beneficiaries. Are you going to be able to carry on delivering the services that you've promised you're going to be delivering to them? Then obviously, which they're grateful to be receiving. And thirdly, again, is how you're positioning them for those who want to support, potentially, give sort of donations, whether it's small or large, and how you're explaining that you're holding that sort of money, sort of tucked away. I think for quite some time, for many, reserves from the charity sector have been seen as a luxury. Probably if you stop the average man or woman on the street, they'd be amazed that charities have, reserves or investments at all. I thought all money went straight out the door on the other side. And probably smaller charities have thought, well, we're never going to be able to have a reserve, so, we're just going to sort of carry on as we are. And I think there's a number of those smaller charities which probably now, if you like, have found themselves under pressure because, as we've heard, the other income sources and streams suddenly disappear, and you're, as I said, the tide's gone out, and you're suddenly sort of found wanting on that. So, I think the other thing is don't be afraid to use your reserves. Speaking from my sort of part as a trustee of a sort of maritime charity, where again we're fortunate we do have significant reserves. We're aware that probably when we look at the other challenge, which is your current beneficiaries, future beneficiaries, where things are going, we're trying to spend them down. But at the same time, dare I say, with this crisis, we've been able to release 2 million to go and help other charities in the sector, because we're fortunate in that position. And I think that what I've also seen though is where charities have come and asked for support, but you're going, but actually you have got fairly sizable reserves, so why are you coming and asking for our funds when actually you should be using those reserves? That's the purpose of a reserve. And so again, I think there's that sort of change in mindset, rather than we've got to have this big swarm of reserve which we can never touch. Now is the moment you're being called upon to use them and use them. I think in terms of, I think the two other interesting points James brings up in terms of, that shortfall, in terms of real terms, the amount of money, albeit globally rather than domestically, which is being pumped, sort of pump priming sort of the economies at the moment, it's akin to 20 times the amount of funds that are available, in the Marshall Plan after World War II, 5 times the sum of money, we saw in Roosevelt's New Deal. And I think this is where the charity sector, in terms of pulling together and making the case for government support. Yesterday we saw 30 billion of measures announced by by the Chancellor. Again, the whole plan of August going out, eating out and supporting, your local pub, restaurant and the like there too. And, what I would question is where is the call to go and support your local charity? And I'd argue that potentially this is where, when we're looking at things like gift aid, we should be lobbying government and going, you've done a kind of a 50% kickback for restaurants in terms of government support. Maybe we should be looking at gift aid and how can we actually make, the actual gift aid benefit even better as a short-term boost to charities to, again, get people in the, out there to remember the charitable sector.
Thank you. So really interesting points there, I think, Will, that get us thinking. So should charities be ignoring income in the future and just look to spend a set percentage each year by adopting a total return strategy?
Well, I think this is also another really interesting, and there's sort of no one-size-fits-all answer to this. What's clear is the investment landscape has changed in terms of, historically putting your money in the bank and knowing or hoping that you would get a return above inflation. That's long gone. So in terms of, that as a place to get income, we've seen in terms of the different asset classes, just domestic equities, you've had over 300 companies in the UK which have suspended or cut dividends so far this year. We would hope those that are suspended, you might see some of that resume next year again as some of this uncertainty disappears and fades. But remember, HSBC and Royal Dutch Shell, between them last year paid a quarter of all the income in the UK market. HSBC is not allowed by the government to pay a dividend until 2022 at the earliest, and Royal Dutch Shell cut its dividend by 2/3. So incomes are under pressure, and I think that the trouble is if you sort of are continually trying to set yourself a high income, and sadly what it was considered a high income continues as ever to shrink. The danger is that sort of the total return you're going to get from the capital and income return you might get from your investments. If you focus too heavily on the income genie, you might think we're getting a super high income here, but actually overall the return you'll get is that much lower. It has been a challenge. I think clearly the endowed charities have a much tougher time with this because clearly they're only allowed to spend the income, and so there's that sort of challenge in there too. Now they do have, obviously since 2013, the Charity Commission, the sort of total return investments for permanently endowed charity sort of guidance. Again, I'd say that that's not a very simple piece of, if you like, sort of legislation to adopt. There's all sorts of areas of complication within it, rather than just saying, well, we can switch this way and then next week we can switch back. So certainly one to consider. But also in terms of the general return you might expect to get, just by going to total return doesn't suddenly mean there's a sort of magic sort of pixie dust appears and suddenly the returns you get increase. We'd argue for probably a portfolio with up to 75% in equities. Realistically, you're looking at inflation at CPI plus 3 to 3.5%, and it's probably nearer 3 at the moment. So, the income, you can probably get an income of around 3%. So again, you can sort of balance it there. But again, if you take that pressure off income, it allows you to go and invest in growth stocks. And you look at America, look at the technology sector, look at the performance of the likes of Amazon and Netflix over this time that don't pay an income, but clearly the growth in that has been absolutely phenomenal. And from personal experience, where we've had charities before, and here I could go back actually about a decade. I remember one school we looked after where they had a very high and very restrictive income requirement in physical pounds they needed each year from the portfolio. And then the one year they went, no, actually, we agree, we're going to move and we're going to go down to focusing more on the total return, a more balanced portfolio, and off we went. We reorganised the portfolio, and within 3 years, actually the income they were getting was higher than their original income, just because of, if you like, the growth that they'd able to experience in the rest of the portfolio. And clearly, if that's growing, you hope the income grows, and so in actual terms, that grows as well. I think when you're then looking at, what's the right level of money to be spending on a total return basis, in terms of, one, there's a percentage figure to calculate, and how do you calculate the value of the assets that you're taking that from? On that, we always suggest kind of adopting a rolling either 3 or 5 year basis, and probably kind of a quarterly valuation point, so that you're I guess smoothing, if you like out the sort of the extremes we've seen in market moves, obviously from both March to June and in the period in between. in terms of that percentage, again, that comes down to the nature of your charity, the types of beneficiaries, what you're trying to do. You know, there's at the moment, if you're kind of a steady state charity going, we think we've got as much need today as we're going to have in 15, 20 years time, then realistically, it's probably a figure of somewhere around 3 to 3.5% you can take out each year, and you would hope the rest of the portfolio grows at least in line with inflation. But, you know, I'm aware as well, you know, working with a number of military charities where, again, you're going, well, we expect there will be fewer you know, soldiers, you know, airmen and sailors going forward, and therefore we probably need to be spending more today, and therefore we're overspending because, again, coming back to that question of reserves, what we don't want to be is in 30 years' time sitting on enormous reserves and thinking about all the people we could have helped or helped more that we didn't do because of the rate of withdrawal.
Thank you. And finally, Will, how have robust investment policies withstood the crisis?
Well, I think in a way, sort of by nature, if they've been robust, they have, I guess, they certainly mean challenged. But I think again, it's like all these things. It's understanding in that sort of in that policy, you know, the what's, the whys, and the hows. And for that, I think the two real key parts, you know, trustees need to be thinking about is risk, and the two elements of risk. You know, so there's one, the risk you think you want to take with your investments. You know, so do you want to have them all in equities? Do you want to have them all in bonds? What are the risks? What are the likely returns in investing that way? And so again, you know, we would argue that if you had a portfolio of 75%, say, in equities, that over an investment cycle, you know, think of it an average term of 7 years. You know, you start at the beginning. We hope in 7 years' time the investments are worth more, but along the way there's going to be a highest valuation point and a lowest valuation point. And probably the move there is a move of 35% or so in capital terms. So, you know, one, that's the risk you're taking. Are you comfortable with that? Because the analogy I would use is a bit like flipping a coin. You know, you decide you want to put all your money on heads. That's sort of the risk you want to take. The really, in my view, most important part, though, is kind of what we call capacity for loss, which is what happens if it comes up tails. If actually your reserves are down 35%, do you have to shut the doors and walk away? In which case, you can't afford to take that level of risk. So, as long as everyone's going into it and understands what they've signed up for, the really key thing is not to panic and change your view when it happens. I think, you know, what you've seen in previous crises is people haven't understood that the way they're invested could lead to this happening. They've taken a short-term knee-jerk reaction, which has proved very expensive. And I would say in this, you know, in this scenario, if in mid-March you decided this is a nightmare, sell up everything and go into cash, today you're really ruining it, because actually the recovery in markets since then has been absolutely phenomenal, and you'll be considerably poorer off because you've locked in those losses. So, you know, I think again it is all those considerations. Again, what are the purpose of the reserves? Therefore, how should that investment policy we have tie in to those reserves? You know, again, it's taking in all those other considerations we know out there. You know, that sort of the wider piece, you know, for a different time, but you know, when it's ESG considerations, you know, ethical pieces, and all those other, you know, pieces which certainly matter. And as I said, sort of bringing that all together so that you are comfortable that you have considered this and you are continuing to review it. You know, it's nothing is ever set in stone. If things change, you change your investment policy.
Thank you. So Rebecca, coming to you now. So following lockdown and the impact of COVID, what have been the financial priorities, and what impact has that had in terms of operations, long-term goals, and the organisational case for support?
Yes, a really interesting set of questions there, actually, Catherine. So I'd like to come to it wearing both a trustee hat and the chief exec hat that I currently wear. So I would say all of us have acknowledged that, you know, we're working in really uncharted waters at this particular time. We've never had anything like this before. We've obviously, many of us, been through the recession before, but we've never quite worked in this way previously. And I think the key thing is that we need, as both trustees and chief execs, to consider how we're going to navigate the fundraising challenge that we're faced. And I would say the challenge is both short, medium and long term, as both James and Will have adhered to. And alongside that, we need to really implement short-term measures. We need to implement those very quickly, and many of us have done so. But then we need to make that sort of pendulum shift to looking at how do we move from urgency into a position of revisiting our strategic priorities, trying to sort of consider whether these need changing, what they need to be done in terms of reviewing them as well. In terms of, I think, financial priorities, the starting point for all of us as trustees and chief execs certainly is that cash flow, which we've alluded to. So I think looking at the 12-month and the 18-month perspective is absolutely vital. And within there, I think we need to all be reviewing it regularly. So certainly, again, as a trustee and chief exec, we are now reviewing our cash flow on a monthly basis, whereas before lockdown, before the pandemic hit, we were probably looking at it on a sort of a quarterly basis as part of our finance committee and regular review. But certainly we're moving now to much more regular review. I also think that within cash flow, we also need to be working far more closely than we have done before with our executive teams and with our staff to really understand what is in there. I think in the past, what we've done is we've looked at our cash flow, we've looked at what money is potentially coming in, what grants are coming in, but we haven't always really drilled down to really understand what's at risk, what is the likelihood that they will defer a payment or change their priorities. And I think more than ever before we're doing that, we're really drilling down and probably in a sense driving some of our teams and staff quite mad actually with that sort of process for drilling down, but it's absolutely crucial more than ever before that we do that. The other thing obviously that we're all doing is looking at our costs, so looking to reduce those or minimize them, looking at where we might be able to defer activities, whether they are services or specific projects, where can we reduce our overheads, can we, for example, get our rent reduced by 50%, or in some cases, obviously there are organisations that have closed up shop and gone to a complete home working base and shut the office down altogether. So I think it's really important to look at how we can minimise our costs. The other area which is priority for all of us has been to look at how can we conserve our income, and also how do we improve our income. And in these challenging times, improving income sounds really quite strange, but by that I mean, how do we talk to our funders who are currently supporting us, and how do we ensure that they will consider us for those one-off grants? So I know many funders who will not only give very generously during the year, but also they're actively coming to us and saying, what do you need now? We recognise these are challenging times, so what do you need? And it's interesting, Catherine, because I moved mid-lockdown from an organisation to the two organisations that are currently in the process of merging. And I would say across both organisations, that has been the case. We've been very fortunate to have some funders who've come to us and said, what do you need? So I think how we talk, how we engage with funders is absolutely a priority. And also how we look to deliver our projects, whether we do that in conjunction with the business community, with partners, with friends, with volunteers, or are we going to be deferring some of those projects as well? And how can we deliver projects in a slightly different way as well? Certainly, and it has been adhered to today, there's certainly some pots of money that we can access. So there's government support, and we'll adhere to the funding that we saw yesterday, which is really positive and really hopeful for us within the sector, even though it's not directly coming to us. But if people are feeling positive, the economy is getting back, we're looking at a V shape rather than the dreaded L shape. I think when people are spending, they're more likely to give to charity and to be generous in their support. But there's also other pots of money, as we know, such as the National Lottery Community Fund. We've also seen people rising to various challenges. So the 2.6 challenge, which saw lots of amazing people, doing things at home, running around the garden pond, climbing the stairs. I think Margaret Payne, our wonderful 90-year-old fundraiser, raised something like 350,000 from climbing the stairs, which was just tremendous. And it's brought that real sense of, I think, of community together, which has been great. I also think, and Will and James have referred to it, the need to look at your funds, to look at your restricted funds, to look at your designated funds, and to look at your reserves is absolutely crucial at this particular time. And I think in the medium to long term, in terms of, what have been the financial priorities, we need to make sure that, in making costs or in deferring, that we're also keeping in mind there is a long-term need to potentially reshape how we do things, to reduce what we might be doing, potentially, sadly, to close some services, or to look at where we might partner with other organisations to deliver those services and activities. And I suppose we're all looking at, in terms of financial impact, you know, what is the likely impact on income across all the different areas. So that is that's really important. In terms of, I think, the impact it's had in operations, well, on the face of it, what we all know is that we've had to cut costs, defer costs, cut services in many cases, reduce services. We've had to furlough staff. We've had to make difficult decisions about whether we're going to make staff and specific posts redundant. But on the positive side, and I like to think I am sort of optimistic, we've also, many of us as CEOs and trustees, have really taken this as an opportunity to rethink how and why we do things, how we do things in a certain way. Is there a better way of doing it? You know, can face-to-face support meetings, for example, move and shift effectively to a Zoom meeting? And we know it can be done, and it's working really effectively. It's also made us look at areas such as, you know, how do we work with the business community? How do we work with potential funders? How do we communicate? And this is really, I think, very important. How do we communicate with our staff? So there's a lot that's written there about how we engage and keep our staff motivated and driven, particularly if they're being furloughed or there's risk of redundancy. And I think that sort of sense of relationship and ensuring our communications are absolutely spot on is going to be crucial, both now and going forward in the longer term. I think there is an opportunity as well in terms of funding to not only rethink how we do things, but to look at opportunities. So, for example, I was reading an article about Terence Higgins, who found that their HIV home testing kits had really just skyrocketed through the roof during lockdown. So people were really keen to be doing testing at home, and that will get them to rethink how they do things in the long term. And I think for all of us, we really do need to be thinking, you know, what have we learnt from the lockdown? Do we need to stay with looking at our cash flow on a monthly basis, or do we shift back to doing it on a quarterly basis? And I reckon that, like most chief execs and most trustees, we will be looking on a much more regular basis at money's in, money's out. How can we do things really more effectively, more cost effectively as well? And I think also we are all very conscious of CEOs and trustees about looking at the prospect of closure or mergers and partnerships. And I like to think that the merger and partnership is what we're all considering in terms of the financial impact. And we're much more now set up to be thinking about who can we partner with, can we do things more effectively by merging.
Thank you, Rebecca. Really useful, I think, and interesting to have your views as a chief executive, but also as a charity trustee, different angles there. So in terms of income profile, what do you see as the at-risk areas and the challenges going forward? And what impact will this have on the fundraising strategy?
So I think all of us acknowledge that actually the events programme is the area that is at the greatest risk and has taken the biggest impact. You know, it can take 6 months to a year to put together a really good quality event. And it can take a matter of weeks for that completely to unravel. And with that unraveling goes your supporters, goes your income. Many of the costs and outlay that you would have put forward, you know, they are gone because none of us were prepared from an insurance perspective to cover for COVID or a pandemic. So I think certainly that is a huge at-risk area. And I think it's going to take a long time to build people's confidence to be both organising events and attending events. So we're not only faced with the fact that, you know, your staff can put together a really super event that everybody can get behind, but we're faced with the fact it can be pulled at relatively short notice, and a lot of work and a lot of financial planning that goes into it is at risk at the same time. And alongside that, you've also got volunteers who will potentially be nervous for a long time to come about engaging in events and supporting events, rattling a tin at an event, etc. And then you've obviously got the issue of social distancing, which you know, as we've come out of the pandemic, that certainly is an area that we're not going to see probably changing for quite some time. I think those organisations who are very heavily reliant on contracts and partnerships will find that their income is hit. both in the short and the medium term. And I know of many organisations who have had very rapidly to lose posts and lose staff and close activities because of that. I think with companies and working closely with the business community, who are incredibly generous, incredibly supportive, and what's been really interesting for me is how an industry such as the pharmaceutical industry has come forward and given core donations when they only gave grants for specific purposes. So for companies overall, I think they've thought creatively about how they can support their charitable partners. But I think there is no question that areas that are going to be hit will be one-off donations and sponsorship. Certainly, we are going to find it really challenging to get sponsorship for events, for receptions, etc. And I think there's no doubt that that will be for a long time to come. I think individual giving and trusts and foundations, they're really interesting areas. I think it will be very dependent on whether we're looking at the V or the U or the L shape with regards to how we go forward. I think what has been reassuring is certainly across all the organisations I've been involved in and talking to other chief execs, what we found is individuals have carried on giving. Maybe not as generously as before, but they've carried on giving. They've given in slightly different ways. And actually what has been reassuring is as yet we haven't, any of us, felt the impact of payroll giving. So, you know, where we found that staff have signed up to give regularly, we haven't yet seen an impact. No doubt that will be coming, but it is reassuring to think that people are still incredibly generous. And, you know, when we look at sort of Major Tom as well and his 32 million, we've seen that the public have really rallied together. Trading, of course, is going to be impacted, as we know, right across both the sort of commercial and the voluntary sector. You know, getting volunteers and recruiting volunteers is going to be a challenge, as is, you know, selling items and how we manage it. And I think one of the sort of areas that is going to be impacted is just the sense of getting everybody's pound. You know, how do we cope with competition? How do we cope with funders refocusing potentially their areas of giving, wanting to give to different causes? So that is going to be challenging. And then I just add a sort of a final point, which I think in terms of the fundraising strategy, for me, there's an element that, do we balance risk and creativity effectively? So as fundraisers, you know, they're incredibly creative people, but how do we manage the opportunities that we can see and how we think creatively going forward to bring in money and protect income versus managing the risk so that at any time we could find all of our events stopped or postponed?
Thank you. Really interesting and varied points there, I think, for us all to consider. And James, I suppose from the discussions today, there's been some, you know, varied points made and different areas that we've looked at during our conversation. And have those discussions reflected the key themes that you're seeing in your work?
Yeah, I think so. You know, the contrast actually between Rebecca's cash flow management and Will's reserves management, and you know how they cross over in this, you know, the real stretch of cash flow analysis and more forensic analysis of what you're spending. You know, that's really been high on everyone's agenda. And then going forward, it's going to be about, as Rebecca said, the fundraising side, the income generation side, you know, in the next 3, 6, 9, 12 months. So there's a balancing act, and there's, you know, I think all elements there have come under more scrutiny from trustees and from management teams. I think communication and innovation was, you know, they were mentioned absolutely, that these are going to be changes, you know, significant changes to communication, how we deal with people. In its way, you know, innovation is going to deal with some of that, but charities are going to have to be more innovative and thoughtful in their funding applications going forward, again, as Rebecca alluded to. And finally, strategy at the heart of everything. And one key element that we've covered before in these webinars is mergers and partnerships and networks coming together. You know, there's a fantastic example of NHS Charities Together coming through in all of this. We know that mergers aren't the most popular thing to happen in the sector for a number of different reasons, but perhaps those very good examples, you know, particularly NHS Charities Together, perhaps that is a model that will show the charity sector that it can be done, and it can be done successfully, and there is, you know, a lot of good that comes out of these sort of things.
Absolutely. So we hope that you've enjoyed listening to this discussion today, and we would welcome your feedback or observations, also suggestions for other themes that you would like us to cover in future webinars. Our next session will be the future of the charity sector, where we will be joined by Karen Bradshaw of Charity Finance Group. Thank you very much for joining us today. We hope you will join us for the other webinars in this series.